Okay. Always really interesting, Julie, and it's really good tonight. So well done. Thank you very much.
Thank you.
I'll just, if you can release your screen, and I'll hand over to Danielle. Now, as I said in the introduction, Danielle's an expert in capital allowances, and I know from previous discussions with her that how valuable they can be, and it's not particularly well understood even by accountants. So very, very much looking forward to Danielle's presentation. Danielle, are you there?
Yep, I'm here.
Good.
Should I try sharing my screen?
That's good. And Julie's put her email address in the chat as well. Okay, that we can see that perfectly, Danielle. Thank you.
Can you see that okay, or is it showing all the gumph?
I can see the main slide, and I can also see the next slide.
Oh, right, that's a bit annoying.
So you should
screen.
There should be a full screen one, Danielle.
Yeah, I think it might be because I've got it on my two.
Display settings.
Is it because I've got it on dual screen myself?
So most people use two screens. I use two screens, and normally we can still, make the slide large. I mean, it is readable, to be perfectly honest. It's not that it isn't readable. I don't know what software you're using. I'm not display settings. Does that not help? Software duplicate.
That better?
Yeah, that's perfect. So we can just see the ones with capital letters. Yeah.
Okay.
How do you want questions? Are you happy with questions as we go through, Danielle?
It's probably best to wait till the end, unless it's something you don't understand. Only because I always think I might end up covering it again, if you see what I mean.
Yeah, that's fine. Interestingly, we've got text of your speech at the bottom as well, which is quite an achievement. Actually, we've never had that before. You should get extra points for that. I think.
How do you get rid of that?
That's come up on the screen as well. Oh no, it seems to have disappeared now. You're fine. Yeah. No, you do.
And it's like subtitles then.
Yeah.
Okay, sorry about that. I don't know how actually I'm going to follow the wow factor of Julie's presentation, to be honest, because capital allowances are slightly less heartwarming, I think, stories there than the outcomes that she achieved. That was really good. A little bit of a drier topic, I suppose, in tax relief. As Chris mentioned, probably something that's mentioned quite a lot, but not really understood by many. So, I'm going to go through. I'll give a brief introduction to myself. I know I've met and actually worked with some of you before, and then I'm going to try and keep it pretty simple and hopefully keep the presentation actually to about 30 minutes, not the hour you'd given me, hopefully, Chris. I don't want everyone drifting off, I'll run through some of the actual tax technical side for those that are interested, but I really won't get into too much of the detail. And then I tend to just explain the two main opportunities, which is around purchasing property and then what we refer to as post-purchase expenditure, which is your refurbishment and fit-out expenditure. And then I wanted to focus on, obviously, furnished holiday lets, serviced accommodation, just because I think that's the most relevant to the audience that we've got here, really.
Yeah, that'd be great.
So I'm a chartered quantity surveyor and a member of the Association of Tax Technicians, which are essentially the two qualifications you should look for in a specialist capital allowances advisor, because we are unique in that it's where the tax legislation sort of obviously crosses over into the surveying territory where the accountants don't really want to go. And I've specialised in capital allowances for well over 10 years now. I moved across from quantity surveying to work at Deloitte and then later at CBRE, and I currently work for myself under Kirana Tax and Surveying, and I work part-time for a construction consultancy business called Chandler KBS. So they've got quite a strong capital allowances team working with some of the big utilities companies and things. And I'm based in St Albans, like I know quite a few of us are.
Yeah, that's good.
So capital allowances, really you need to focus on obviously the first part of the name, which is capital. So it's when you're incurring capital expenditure, not revenue expenditure. Capital expenditure that's going to hit your balance sheet, not go through your P&L. So I say whenever a company or individual is spending money on commercial property, you should be thinking about capital allowances. So as long as you've got a commercial property, it's not available on residential properties, and any of those elements to that property cycle, capital allowances will be applicable.
What about mixed use, Danielle?
Mixed use, definitely, yeah. So with a mixed use development, you basically you use sort of more of an apportionment and sort of apportion out. Again, you'd need a surveyor to do that, the residential element of the property, but yeah, you certainly can claim on the commercial. So I'll be focusing mostly in this discussion on the acquisition side, because I know most of you have obviously acquired property, and fit out and refurbishment expenditure. But it does come into play if you've got a lease incentive, which is sort of a landlord incentive to bring a tenant in. Capital allowances are applicable then as well. And obviously if you're actually building a new property. So okay. So the basics. So capital allowances is, as I mentioned, a tax. It is called a tax incentive on capital investment. It's set out in the Capital Allowances Act, which is sort of detailed part of tax legislation. And it is utilised to provide, I suppose, incentive on that capital investment for businesses, property developers perhaps, but businesses likewise. And the capital allowances are available on both income and corporation tax. So it is applicable if you obviously own a property personally, and you've maybe spent money on it yourself and you're paying income tax, or if you're a non-resident, you hold it in a offshore company. It's available on all commercial property, as I mentioned, not residential. Now, the complicated bit with capital allowances, which I think starts to make people fear it, and it all sounds a bit complicated, is because accountants and things will start talking about the various pools. So essentially, the complexities are around segregating that capital expenditure into these various pools that the tax legislation sort of, that they alter and change those pools and the reliefs you get in different legislation all the time. So what capital allowances specialists do is draft up a capital allowances claim outlining all of the different pools that you can claim the capital allowances on. And then the final capital allowances, I suppose, figure or number actually reduces your tax liability. So it doesn't reduce your profits, it's your profits chargeable to normally corporation tax, it could be income tax. And then if you're utilising capital allowances properly, they'll come in and reduce that liability. So who can claim? any UK taxpayer, those that it's easier to say who can't claim. So if you're holding a property in a pension fund, or it's a charity or a local authority, obviously they don't pay tax, so they won't claim capital allowances. And the entity that claims the capital allowances has to be the entity that incurs the capital expenditure. So, i.e., if you could have a family that decide to purchase a property and refurbish a property and then operate a business out of it, but that limited company may not own the property and have incurred perhaps some of the capital expenditure. The limited company might be the profit-making company you want the tax relief in, but if they didn't incur the capital expenditure through that company, they can't claim the allowances. It will end up being the actual entity that incurs it. So that's just a peculiar. It's something you have to be aware of potentially if you want to keep tax relief in a particular part of maybe your portfolio or your businesses, if you have a sort of operational business as well. So part of the work that I do is to obviously verify that to claim capital allowances, you have to hold what's called a relevant interest in land, so either a freehold or a leasehold interest. Now, obviously, normally people can't operate out of properties without holding either a freehold or leasehold interest, because that would be illegal. But it's just to make the point that if you are a leaseholder and you're incurring costs on a property, you can also claim if you're operating a business from a premises as well. People often don't think that's the case. So these are the main types of relief available, and really this is quite detailed information, but some of you may have heard you may hear it being spoken about with your accountant and things. So I don't want to go into really the real detail of this, because I think what you'll get more from is sort of some of the examples we've got later on and things. But I just wanted you to be familiar with some of the terminology. So your annual investment allowance as a company is the amount that currently you're allowed to get 100% relief on in year one. So essentially it's this expenditure that's written off altogether. So if we identify £100,000 worth of capital allowances and you claim it in your annual investment allowance, you get £100,000 written off against your profits. So at the current corporation tax rate, you'd save £19,000 of corporation tax writing that £100,000 off. If it doesn't fall into your annual investment allowance, it would fall into the plant and machinery allowances or integral features and some of these other descriptions, and you get a much slower relief on your capital investment. So the point I'm trying to make here is that as a smaller business, across all your businesses, you'll get the first £200,000 at 100% relief. It's currently it has actually been increased to £1 million, but it's going back down to £200,000 next year. But essentially, the first sort of slice at the cake, so to speak, has to be claimed within the first 2 years, this annual investment allowance. And if you don't make your claims within the first 2 years, you do fall into these other pools, which are the plant and machinery pool, the integral features pool, which are listed here. And that basically means that you get much slower relief. So the plant and machinery allowances are written off at 18% a year. So that 100,000 we just spoke about, instead of getting 100,000 relief in year one, you'd only get £18,000. So you're only getting then the tax saving on the £18,000, if that's making sense. And obviously going even further down, if it falls into integral features, so things like electrical installations, mechanical installations, you're only going to get £6,000 written off after your 2 year period. So it's just trying to focus on making sure you get maximize is what the terminology is, sort of maximizing that annual investment allowance that you're given for 2 years after you've incurred, either purchased or maybe fitted out a property.
Yeah, so it's a bit, isn't it, to the integral features from the annual investment allowance?
Yeah, I mean, and that's the purpose of them doing that is to encourage people to obviously make the claims, because you can actually make a claim. You can go back 5, 10, 15 years, but you'll get this lesser relief. So, you know, it just encourages, I suppose, people to focus and keep on top of things. And they do actually restrict that annual investment allowance across. You have £200,000 across all of the companies that you control. So again, you can't set up another company to get another £200,000 annual investment allowance, because you're going to maybe buy a piece of plant and machinery or refurbish another building. So that's another thing they do. Sorry, I don't know if you can hear the firework display going off literally in my neighbour's garden. I'm sure you can't hear it as much as I can, so I'll try and ignore it. It'll be over in a minute.
Hear a little bit of, but it's not significant. It's
yeah. So I wanted to actually flag the land remediation relief, which is the 4th point there, because that actually could be applicable to quite a few, because that includes asbestos removal. So if you're removing asbestos from a property that you've acquired, therefore you're not the contaminator, you should be collating those costs essentially and keeping them together, including any sort of consultative work and then the actual removal. And then your accountant is able to claim 150% deduction of those costs. So if you spend £1,000 removing asbestos, you actually deduct £1,500 through your company. You get an enhanced deduction for doing that.
That's very usual, isn't it, to get a relief greater than the cost? I assume it's because the government's encouraging people to, clean up the poor land and not ignore it, give it incentive.
Yeah, definitely. And actually, it's one of the few areas where you can get a tax credit if you're loss making. So if you incur that and you've got a loss making business, you can actually apply for a tax credit against some of the cleanup costs. So, I mean, some land, I mention asbestos because that's sort of the most common discrete amount that people come across. It obviously it is applicable to, quite heavily contaminated sites if you're doing a really substantial project and cleanup. But, you should be consulting a specialist to make sure you really maximise that relief, actually. Because you're right, it would almost put you in a loss-making position for tax purposes, obviously, which is quite beneficial going forwards on money that you hadn't actually incurred. So, yeah. And then structures and building allowances is a new relief that even if you don't, if you're doing a refurbishment or fit out project after October 2018, there's a new unusual allowance really that you can now claim 3% relief on what we call the structure and building, which historically you'd never really been able to claim anything under the capital allowances legislation on your structure. It was always other sort of parts of the property that under legislation were deemed tax relievable. So this is a new relief that was brought in, and it's obviously it's not huge, it's only 3%, but it's certainly something you should be making sure that your accountants are doing and are aware of, and that they've checked. I think you have to have entered a construction contract after October 2018 and brought the building into use, effective use after those dates. So not anything before that. It's then not qualifying. But that's another relief that's hopefully quite straightforward. And then I threw on electric car charging points here, just again, because you get 100% reduction on those. It's the green technology that they threw in that apparently are obviously, you know, being installed more and more, commonplace everywhere really. So just make sure if you're incurring costs on that for any reason, that you're getting the full deduction.
This is all great stuff, Danielle. We had a question on the chat, and I think it was to do with the land remediation relief.
Mm-hmm.
And would that apply to Japanese knotweed? That's a question.
Yeah.
It would.
Mm-hmm. Yeah.
Okay.
So that's the contaminant. Yeah.
So if you had a piece of land and it was covered in Japanese knotweed, and then you built a commercial building on it,
mm-hmm.
you could claim 150%. And presumably, if it was half commercial, half...
No, sorry. It's just on the clearance aspect that you get the relief.
Yeah.
Yeah, so if you clear the Japanese knotweed and get a contractor in that charges you £30,000, you'd actually, you know, deduct 45,000, you know, on it. Yeah.
But if it was, but it has that what gets built on the land has to be a commercial property.
Do you know, I'm not sure actually. I haven't come across it on like land clearance. I'd have to double check whether if you did then build residential, I think it may well still apply actually. Yeah, you're still clearing up the land for development. So no, I'd have to double check that. I haven't come across that exact example myself.
Okay.
Whether it matters, you know, what you then go on and do with the land. Yeah. Because
that would be really interesting, wouldn't it?
Because essentially, yeah, they do just want these sites cleared up, don't they? So yeah.
So with that also, so I'm talking to a guy who's got an old petrol station. So he's got the big fuel tanks. In fact, he's got 3 of them. Would it include that as well?
Yeah. I think that's quite a common one actually. The issue is what they've agreed, you know, post with the person they purchasing the petrol station from. There may be legislation around what they need to clear the site before it's, you know, passed on, seeing as it obviously was used as a petrol station, which is quite a known entity when they constructed it. There should have been something to describe how they were going to decommission it properly, because you only get the relief if you're not the contaminator. But I suppose if there's a way round of not paying for it and someone else paying for it because they're the contaminator, there is law, I think, around them trying to get them to pay for their own clear up. Yeah.
Oh, right.
Yeah.
Okay. All right. Thank you.
Right. So this, I'm just going to run through, concentrate mainly on purchase expenditure, which is your acquisition costs on property. The main reason I'm going to concentrate on that is because it is the more opportunistic and complicated part of capital allowances, really. The post-purchase is a bit more straightforward and is more likely to be picked up by your accountant. But the purchase expenditure, I would challenge anyone whose accountant carries out these claims themselves. They really normally don't want to go anywhere near them, and they will probably, if somebody has done one for you, I would have thought outsource it to a specialist anyway. Now there's quite a few reasons for that, but one of the main reasons is in order to make a claim on a purchase on a property that you're purchasing, we have to do what's referred to as entitlement research. So we have to trace all of the owners back to this date of 24th of July 1996. Now that makes it sound quite complicated. In actual fact, due to some of the legislative changes and things, it sometimes works out that it's a little bit more straightforward than that, and that we get to our answer a bit sooner. For example, if I trace back the owners of a property and it's been held by a pension fund for 20 years, I know that there's clear entitlement because the pension fund won't have claimed on the property. Also, obviously, a lot of properties weren't even built in 1996. So when I speak to the land registry and find they were only sort of constructed in 2001, I know which legislation to look at. Now, some key points here is if you purchase a property, a commercial property, after April 2008, and that means you're the first owner after the introduction of some new legislation, and therefore you will be able to make a claim on your purchase expenditure. So that gives sort of me, as the specialist, clear entitlement to go ahead and make a claim for you. Another key date that I've put on this slide is April 2014, which again, as sort of property investors, you should be aware of, because after April 2014, they brought in something called the mandatory pooling. So prior to 2014, specialists like myself could basically go and look at any commercial property and go back as far as we like to make capital allowances claims. So I think what you had happening was, you know, the legislation was only introduced obviously in 1996. So there was a period of, you know, working it out for 10 or 15 years. And then you got a lot of specialists realizing that they could go back in time and make historical capital allowances claims that were quite lucrative to businesses. So they basically brought in legislation that was probably overdue, in terms of 2014 gives them a bit of a line in the sand. So if you don't clarify the capital allowances position on a property purchased after 2014 and you don't make a claim, then you've essentially lost all the claims that could be made on that property. So if you're sitting here thinking, I bought a commercial property in 2015, say, and then I haven't, you may well have you've now lost the opportunity, if you could have made a claim in 2015, to make it, because sort of 2 years have passed from, so you would have only had till 2017 to sort of firm up your claim. So it's sort of been swings and roundabouts for specialists like myself, because actually it really focuses people's efforts and minds at the time of acquisition and disposal on checking what capital allowances they could claim, whereas before they could always put it to the bottom of their to-do list knowing they could go back and make the claim. But it does also sadly mean that occasionally we come across properties where the period's just passed and there's nothing you can do anymore, because that's what the law states. So yeah, the key dates are 2008 if you are the first owner of a property. After 2008, there's often an opportunity. And then if you're currently purchasing a property or have done in the past few years, it's worth checking the entitlement before the lapse of the 2 years. You've got 2 years to make a claim from purchase after your 2014 date. So I know that's a bit complicated, but I'm trying to get across just the key sort of dates that you would need to keep in mind.
So that 2 year period isn't that long, really. So how long would a claim? Because I was thinking, well, if it takes 6 months to put a claim in, you've actually then got an 18-month window, not 2 years.
It doesn't take. It's 2 years from the date that you purchased the property. But remember, you put your claim in with your tax return, so you sort of got that lag period of the year that it fell in, if that makes sense. So you normally, but yeah, I mean, essentially, if you, for instance, bought a property in March 2015 and your year end is June, you've only got till June 2017 to get that claim together, you know.
Wow.
But yeah. So
Okay.
yeah, the key message there is obviously ignore your capital allowances and you could lose them, but that's only on the purchase expenditure. They have to be what's called pooled. We talk a lot about pooling. It's a bit of a strange term, really. It just means writing them down in your tax return, really, and then they're often either claimed they can be claimed by the current owner, and then when you come to sell the property, you can decide whether you want to disclose your pool or the amount to the person that's buying the property, and they can be transferred across to them to be claimed. So in terms of what you can do, most of the points that I've just made the 2 year point, but most of the points I want to get across are around essentially asking the question when you're buying and selling property, And the key point to probably make a note of is speaking to your solicitor to ensure that they're actually responding to the CPSCs correctly. So following 2014, the CPSCs section 32, which relates to capital allowances, became a lot more detailed and a lot longer, and they actually refer to your capital allowances advisor within the new CPSCs, trying to remove the sort of the grey area that there was before, because what would happen, or does still happen, is that the accountant says that the solicitor should respond to these questions, and the solicitor says that the accountant should respond, and sadly what I see all the time, really all the time, is that they just write not applicable. So by the time it gets to me, nobody's responded. But you have got that window of opportunity, particularly before a deal is sort of gone through and been completed, just to speak to someone like myself, who will quite quickly be able to tell you whether it's worth putting a clause in the contract to protect your position and give you that 2 years to be able to claim.
CPSC, what does that stand for? Just
sorry, the CPSCs are your commercial property standard inquiries. So they're the list of questions that your solicitor, I don't know what the residential equivalent is, but it's the standard inquiries produced by, I think, the Law Society, property, that most solicitors, they have to issue with the sale and purchase contract. So they will ask, have you claimed any capital allowances? Could you claim? But you know, there's quite a couple of pages of questions there.
Okay.
I don't know if I've got a few questions here on the chat. Oops, I'm not sure I can see them.
No, it's just about people losing.
I think there's someone had Melinda had a sound issue, losing sound.
Right, okay.
Mine's been fine, and
Yeah.
Julie's has been fine. So I think that might, Melinda, that might just be with yours. You might just want to make sure your speakers are plugged in, or whatever.
Okay.
Slides.
So yeah, one of my key messages is around those commercial property standard inquiries in your sale and purchase contract, really. And I speak all the time on the phone, just running through these with people. I don't charge anything to discuss that. That's all part of, you know, what I do is establishing if there's a claim to be made. That's when it sort of kicks in, and I can make money out of, you know, doing the claim. So never ever sort of be worried about, if you're dealing with a transaction, giving me a call to run through, or just sending me the CPSCs, and I always deal with those and get that sorted, because it's obviously, you know, in your interest, or if you're selling it, perhaps the buyer's interest to retain the capital allowances. So that's always offered free of charge.
Okay. Thanks for that. We've lost your slides.
Oh.
You know, when you went to look at the chat.
Oops.
Oh yeah. It's just coming through. I can see a commercial building. Thank you.
Let me just go back. Yeah, so just the bit I just wanted to then, if we identify that you can make a claim then on a commercial acquisition, I just wanted to explain what happens, what we mean by a claim, really. And essentially what my job is then is to do something called an apportionment calculation. Now, the easiest way I usually explain this to people is it's a bit like a reinstatement cost estimate for fire insurance purposes or something like that. Under the tax legislation, you have to basically reapportion the amount that you've acquired the property for into sort of three sections, which is the land, the building structure, and the plant and machinery. So obviously that's where this part of the service lends itself quite clearly to a surveyor carrying out the work, because an accountant is not going to apportion, say, 500,000, £1 million into what they think the component parts of that acquisition is. And then these percentages are essentially apportioned to your actual purchase price, which is obviously a market value number. That's not actually what, say, the bricks and mortar could be worth, because it's an investment, but that's just for tax purposes. And that's why this is obviously quite overlooked by accountants and things, because there is a long-winded element to it, in that we need to do the tax history first and then carry out this report, which is then attached to your tax return. But realistically, once we've done the tax history, I'd say it's a very, very straightforward process, and you know, something that accountants readily would sort of recommend that you get a specialist involved. The other pot of I suppose capital expenditure I wanted to talk about is the post-purchase expenditure, or refurbishment and fit out expenditure. Now, this is obviously what you'll probably be more familiar with, because you've, I'm sure, all incurred it yourself on properties. With this is just clean, fresh capital spend that we don't need to do all that research on, because you'll have records or information of what you've spent. And essentially here, your accountant probably will look at this in some sort of, to some degree. I think a lot of what I see, I suppose, with smaller businesses and things, is that accountants don't want to break any numbers out. So if you've got a builder, say, who's just done 100 grand's worth of work for you, but they might not have actually given you a breakdown to that in its real detailed component parts, because you've just agreed it, you know, as you've gone along and things, and a lot of builders just don't provide that level of service. What I can do is then go in and actually survey the property and then give a reasonable assessment, again for tax purposes really, on what you've spent the £100,000 on, and append that to your tax return to get the best result. And it's just because accountants, I suppose, are, you know, they will be risk averse in that way, so they won't want to split it out unless they know exactly what you spent it on. So then they just don't. So you don't get the relief. It just sits there as non-qualifying. You know, it's not a service that they're going to sort of charge, or you know, always going to be included. So it's again just something worth being aware of, I think, when you're working on a commercial fit out.
So with something like sound insulation, or any insulation really, you know, a lot of that cost is hidden. Mm-hmm. You might, how would you just take a trust, or, you know, would you expect photographic evidence of the insulation, because things like sound and acoustics can be quite expensive?
Yeah, I mean, it really varies from case to case with me. Occasionally on a fit out, I would still probably visit it if I could, and then I'd really just run some estimates on, you know, what would be deemed reasonable. I've obviously got credited costings, things like spawns and building cost indexes if I want to, and then they're fully sort of accredited by HMRC. They're not going to quibble with those. But, you know, I do also use more current information. If I'm just aware that something costs a certain amount, you can justify that. It's about pulling out the info really, just so that you haven't got you know, a quote that says extension to XYZ, and it includes maybe all the electrics and plumbing, and you just say to me, oh, that was just the price that included everything, we didn't get a breakdown. But we can actually sort of break that out whereas an accountant wouldn't do that. Yeah.
Okay, yeah, because that's where your knowledge, your knowledge of quantity surveying comes in, really.
Yeah, and sort of the sound basis of how you sort of just estimate it.
Yeah. Thanks.
So a couple of case studies. These first two are on purchase expenditure. So the first one is a mixed-use commercial property in Loughborough that was acquired for, so the total consideration was 232,000. So we include things like stamp duty, legal fees, that sort of thing in the consideration. That was in 2018. Now, we couldn't get full clarification on what capital allowances had been claimed by the previous owner. However, the client was the first owner after 2008, which meant I knew that there were certain assets they could claim on because no claims would have ever been made before because the previous owner couldn't have claimed. So we managed to claim what are called integral features only on the acquisition before the refurbishment happened, which is probably another key point actually, is obviously once you strip assets out, I can't go in and make a claim once they're gone. So if there is the sort of lag, then you're best to do the purchase and then look at the refurbishment expenditure afterwards.
Right.
So we identified £15,000 roughly of capital allowances, and these could either be used as losses carried forward against the investment, or that would equate to a tax saving at corporation, standard corporation tax of 19% of £2,900.
Yeah, that's good.
And then the next one is a bigger mixed-use investment up in the northwest, and this was, as you were describing, Chris, mixed use really, in terms of the ground floor was mostly retail, restaurant, that sort of thing, and then upstairs was obviously residential. So it was quite a hefty price tag of 1.8 million on this one, and again it was only the integral features that we could claim on because the previous owner was not available to cooperate or pull. And what actually did for this client was they did just want to maximise that annual investment allowance. They weren't interested in getting allowances anything over that really. So we just focused on maximising the annual investment allowance and getting them the full £200,000 deduction, which then meant that going forward on this investment, they had £200,000 worth of losses to carry forward, which is just nice, quite a nice, clean, clear position to be in, really, that you know you've got that. And if they'd, as I said, they did do some work to it, so they again may have stripped some of the things out, I'm not sure, but if they hadn't engaged within that 2-year period, then the opportunity would have been lost. And then 2 or 3 years down the line, they may have been saying to me, can we claim capital allowances? And they fall into those other pools. It's just not as beneficial. So this just means they've got sort of clarity, I think, going forward on their investment.
Yeah, no, that's really welcome, isn't it? That's a bit of a game changer. That's a great start, as you're saying.
Yeah. So just moving on to the furnished holiday lets and your serviced accommodation. So I can carry out capital allowances reviews on properties that are classified for tax purposes as furnished holiday lets. So most of you will probably be familiar with some of this, probably more so even than myself, actually, the criteria you have to meet. But yeah, it is obviously that definition for tax purposes if it's being treated as that by your accountant. It must be a property based in the UK or the European Economic Area, be furnished, sufficient furniture for someone to have normal occupation, and be commercially let, so therefore it falls under the commercial property rather than residential. Now each furnished holiday let is treated as a separate record. So for capital allowances purposes, it's worth flagging that if I identify capital allowances on one property that might put that property in a loss-making position, unfortunately, you have to carry them forward against that record. You can't maybe offset the losses due to the capital allowances. They're ring-fenced against another furnished holiday let that you might have. So that's just a bit of an intricacy where it's saying that they're sort of treated as a separate record, and the losses are actually ring-fenced. So the occupancy conditions, again, total of all lettings that exceed 31 days is more than 155 days during the year, then it's not a furnished holiday let. It must be available for letting for at least 210 days a year, and must be commercially let property to the public for at least 105 days a year is, I think, the current guidance.
Yeah.
This is a good case study on a recent refurbishment, actually, of well, it's more of a complete reconfiguration fit out. Shouldn't really have called it a refurbishment, actually. So it was conversion into 6 apartments, and they spent 541,000 on this, so quite a lot of money. The accountant came to me, actually, stating that he knew they'd spent a lot of money on this investment, and he'd identified £67,000 worth of capital allowances against the investment, but he knew that that was sort of what all his, general knowledge meant that he could pick out. So he forwarded us the rest of the information, and we identified another £95,000.
Oh, wow.
So that will give future tax savings on the extra that we identified of £18,000. So obviously, well worth making sure, fortunately, this accountant, I think, knew where to draw the line, and stated he didn't want to look at it in any more detail, and he'd rather that it was just outsourced, and the client obviously pays a percentage fee against that 18,000 to get the rest identified.
Wow.
And then another client of mine, he refurbished 3 flats, actually, in Norfolk for just shy of £100,000, and identified nearly 50% of that in the annual investment allowance, and that resulted in tax savings of £9,000 in the first year. He had a small contaminated land claim here, and we also identified some revenue expenditure that had been sort of incorrectly capitalised by the accountant, which also means it's all sort of just, it can be go through the books as revenue expenditure, giving enhanced relief rather than being posted as capital. So the total tax savings there were £13,000 on that project.
Wow.
So with the furnished holiday lets, if you're actually acquiring a property that is already obviously being operated as a furnished holiday let or serviced accommodation, we can look at the acquisition cost as well. But we will have to do that, obviously, that due diligence that I spoke about, but it may well be the case that the capital allowances haven't been maximised, and you may be able to claim on the acquisition as well. It could very easily be overlooked, particularly because they're often considered, obviously residential.
Yeah.
But most capital allowances are going to fall, I would have thought, in some of the refurbishment costs that you incur when they're capitalised. And that, I think, the key, as explained earlier on, is really about getting as much of that in the AIA, not waiting until you're potentially tax paying further down the line. It's actually quite beneficial to realise the capital allowances as losses in year 1 and 2, and then carry them forward against your investment.
Yeah.
May create losses to carry forward or back. And I will say on that point, what I've done with normally I cap my fee if I'm identifying what's going to be a loss, creating losses to the business, because obviously it does involve a payment for something where you may not have been paying tax out. So it's not as clear cut as the tax saving, but generally people do see it as incredibly beneficial because of the 2-year time frame to pay that fee for identifying those losses, rather than going without them sort of 3 or 4 years down the line when you need some tax relief and you can't really access it.
Yeah.
So that's pretty much it. In summary, I think my key message is always around the information gathering and asking the questions about the pooling right at the beginning, just to get the clarity that you need when you're buying a property. Checking the CPSEs, checking who's responding to the CPSEs and that they're actually asking the right questions. The opportunities where you should know that you're going to have a capital allowances claim is if you're the first owner of a commercial property after 2008, if you're buying a property from a pension fund, a charity or a local authority, and then just the clarity around if you're going to actually be utilising the property as a furnished holiday let, to be aware that you can claim the capital allowances. Because I know I have come across quite a few clients where they buy a property and they're not actually quite sure how they're going to let it to begin with. So it's just also being aware of that you will get the tax relief if it ends up being let as serviced accommodation rather than on an AST. And then the annual investment allowance, I always, go on about quite a lot to smaller businesses, really, because it is very valuable tax relief, and if you don't use it within the first 2 years, you do just lose it. I think that's it.
That was excellent, Danielle. Thank you.
It's a bit heavy, I know, but hopefully you've got some bullet points to take with you.
Yes, no, I think
the auctions.
So partly it's about understanding not necessarily the detail, but the opportunity that's there with capital allowances to then go and seek, people like yourselves who are experts in this and maximise the benefit. Really, that's what I really like. I'll open the mics up. So if anyone's got any questions, please put them in the chat or just open your mic. Richard, did you want to open your mic?
Yes, I just had my mouth full of crisps. So,
oh, sorry. Sorry.
Yeah, in a lot of commercial properties, a long leasehold already triggers stamp duty land tax. So in Revenue's mind, this is already on the way to a purchase because they're happy to tax. So I'm wondering, are these allowances only for actual purchase, like freehold, or are they also for a long lease and leasehold?
No, they are for long leaseholds as well. Yeah, if you're paying a capital, a large investment sum for the long leasehold, you're correct. You can still claim the capital allowances on that amount. Yeah.
Well, even on a shorter leasehold, if it's a big enough property and it triggers stamp duty land tax.
Yeah.
So is that the trigger for it, or what is the trigger to say that you can claim it on that?
Normally it is if it's specified as a long leasehold in the title documentation, and again if there's a capital payment against that, then really it's seen under the legislation quite similarly really to the freehold, but that's on a longer leasehold. I think that the worry with a shorter one, I would say, because the way the legislation is geared is that you're obviously buying that property. If it is a slightly shorter leasehold, it would be whether there was another, the freeholder actually had obviously the repairing and rights to the actual building, and you're actually just paying a premium for the shorter leasehold.
Okay, on the one I'm thinking of, people who visited our business centre, that's a leasehold one, but and we would have to pay stamp duty land tax. but it's not like 20 years. And we're responsible for all the upkeep of the building and the grounds.
Mhm.
And my question earlier about Japanese knotweed, it was a similar question, but not that particular species. There's another one called Tree of Heaven. It's our tree from hell. And as you cut it, it grows like the Hydra with 10 more come up in its place.
Oh my
Oh, wow.
gosh.
And our landlord, dear Lord Salisbury, they are not eager to contribute in any way to it.
To removing it.
Yeah.
You'd have to check. I can check for you, but there's there is detailed legislation on what is considered a contaminant, you see. So I don't know whether that particular plant will be on there.
Okay.
Yeah.
There was a funny aside on that one. The local authority have misidentified it as a beech tree, and they've put it on the protected tree list.
So you can't get rid of it.
Oh God.
No.
Oh dear.
Anyway,
So-
no, that was a question more about other things that we did in the building too.
Mhm.
If we're paying tax on the lease as well, you know, as you buy a leasehold apartment or house, if you buy that, then you might have to pay stamp duty, land tax.
Mm.
That's what we have to pay on our lease on that building.
Yeah.
So then is there a particular trigger really for how much of any expenditure on the building, if it's still a leasehold and the landlord or the freeholder isn't actually paying for some other things like maybe new boilers or insulation or something like that?
Yeah, I mean, I think that the key would be to go back to the title information actually with the land registry to see, do you know how long the leasehold interest is that you've bought?
Well, okay, so this is a short one. Maybe this is a separate inquiry offline then.
Yeah.
Okay.
Yeah, because I mean, my starting point is normally when you purchase a long leasehold that is over at least 25 years.
Okay, it's
I
not
mean,
like
most
that,
of the ones I see, a long leasehold is sort of 999 years, so it's sort of considered almost the same as a freehold, really. But yeah,
no, it's not like that.
yeah.
Okay, thank you.
Okay, that was good. Thanks, Danielle. I did maybe just while you're answering the questions, Danielle, you could put your page up that's got your contact details. So if people wanted to contact you, that'd be really good.
Yeah, I don't actually know if I was clever enough to put it on that slideshow.
Well,
Well,
if you, I'll put some details on the WhatsApp, or we'll put some details on the WhatsApp group tomorrow for you, if you haven't. A quick question from me, which was, you had that example of the accountant who identified or thought he'd identified £67,000 of claim, and then you identified another 95. I just wondered how many accountants even think about capital allowances, because it's not usually all that well understood because it's quite specialist.
I think depending on the smaller general accountancy practices, and I actually sit in, a friend of mine won't mind me saying this, she runs one with her father in St Albans, and I go and sit in their offices occasionally to work elsewhere. The general getting the accounts and tax comps for most companies done and completed, the thing is, often by the time they realize that they've got to look at this, it might be quite close to a deadline anyway. Now you've got the 2 years, so they will flag it, but it's just not a priority of theirs, because if they're doing your sort of general annual or maybe monthly work for you, unless it's something that you've specified, I just think with a lot of companies, they do obviously see it as up to you to investigate that some of the time. They may flag it, but obviously it just really varies from accountant to accountant. I mean, that particular accountant, I'd say he was pretty astute, really. He'd been through it all. He'd picked out quite a lot, and then said I wasn't sure on the rest of it, so I thought I'd, you know, tell the client to engage someone else, which is really good. It's better that you'd rather that than they just sort of identified a bit and said, oh, don't worry, we've identified some, that's fine, you know, which is probably more common.
Yeah.
That they'll identify a few easy things like your kitchen installation, and then you see capital allowances, so you think they've done it, but it hasn't actually been maximised.
Well, as you say, on the form, they normally just put NA and move on, really.
Yeah, the real opportunities obviously are around purchasing. You can really, it's a dead cert that the accountants won't have looked at it. Yeah.
And if you, so this is something I'm quite interested in, is if you buy, say, a furnished holiday let in one sort of legal entity, and then was going to transfer it to another, do you lose all the capital allowances, all that tax credit, if you like, that you've built up?
When you what, sorry?
If you were then to transfer the property to another legal entity, what happens to the capital, sort of the tax credits that you've built up?
No, I mean, you've got various options when you move property. If you're moving it between connected parties, then you'd normally transfer at the tax written down value and continue claiming. Okay. If you're bringing the property to market, that's where, again, you should be speaking to maybe your accountant to decide whether you want to offer the capital allowances to be transferred in the sale to the new owner, or you can elect to retain them and sign a 198 election, it's called, a pound, so the new owner can't claim and you retain. Quite a lot of the time, unless you've still got income coming in that company, it's not going to be worth you retaining them anyway, so you'd obviously then offer them, and it's quite a nice thing to obviously be aware of when you're selling the property, that you can offer a future investor, because you've got the information there and they can claim. Yeah,
no, that's okay, that's interesting, actually. And I
sorry Chris, can I just say something? Can I just ask Danielle something? Yeah, sorry. You know, I remember you saying about this 2 year, when, you know, we had a meeting with Chris and Liz a few years back, about you claiming 2 years, you know, once you bought the place, because that's when you would get your most amount or profit, let's say, from, or tax allowance, capital tax allowance. But after that, can you claim anything?
Yeah, you can still claim. It just becomes, you basically are spreading the claim over sort of up to 20 years. So if you say go back to that £18,000 tax relief that you got in year one, it means that you might get £1,000 tax relief, you know, over 18 years is how it works. So the thing with my work is it just becomes less attractive for the client, because they don't necessarily want to pay unless they're getting a rebate or a lot of tax relief in year one for a service. I mean, it can sometimes, the numbers work out, the bigger the numbers are, obviously, but occasionally it can mean that you're just getting quite discrete amounts of tax relief over a longer period of time. That's the only concern, yeah. But essentially, you can go back as far as you like. So, and the more properties you've got, obviously, the more important it is to check, because, you know, I've done quite a few reviews in the past on 10, 15 properties, and we've gone back years. But obviously, if you combine all the tax relief together, it's a worthwhile exercise.
Yeah. Okay, yeah, great, thank you. Yeah,
good question.
Yeah, very interesting.
All right, thanks for that, Ori. Good question,
Yeah.
Thank you. Any last questions from anyone?
Chris, just not so much a question, but thanks, Danielle. That was great.
Yeah, but it's one of Andy's properties.
Yeah, and I will vouch for your services. It has helped us massively. Yeah, I'm a case study that we're really happy with. So that's great. One thing that I think that might have got lost in translation to some of the people, and they may not understood it, because you talk heavily about commercial, but our examples is one which is that we bought commercial but converted to residential, and we carried those forward. So people with people doing the commercial conversion strategy, it's really beneficial, and obviously partly one of the reasons why we went down that route, and we're looking at commercials going forward, because it's actually at the conversion point where you have we now have a residential property, and those carried forward losses for until we use them, which is great.
Yeah, that's a really good point, actually. Yeah, thanks, Andy. Yeah, I hadn't mentioned that.
Yeah, thanks, Andy. That was good. And so what's really nice is, Danielle, if anyone's got any queries, they can contact you for, you look at the opportunity if there is one, and there's no cost to that. So it's sort of risk-free for people, really. Yeah,
I normally charge, well, the market, everyone generally charges what we call an incentive fee, a percentage fee. But likewise, I'll often look at what we're doing, and I can fix fees if people prefer to sort of have that transparency as well. Yeah, and
of course, the investor property owners making savings that's far in excess of what your fees are, so that's really good.
Yeah, I mean, I never proceed unless I'm going to save money, because then no one's happy.
Sense, Danielle. No, thank you. That's great.
Thank you. Very good. It's very good. Thank you.
Yeah. Thanks. Thanks. Okay, so I'm just going to move on. So on the screen, I'm just sharing the different ways you can get in contact with us. And as I say, if anyone's not on the WhatsApp group, then
I can't see it on the screen.
Please, can you see this? It says I'm sharing.
No. Do I need to stop? Yeah.
Sorry?
That's it.
You've got it. Oh, okay, Lisa's got it. So hopefully the world is fine. So so just get in contact with us that way. And then for next month, I've got Jay Howard, who's co-author of a book on property auctions, and what he's going to do is going to run through, why use auctions for property purchases, common mistakes that people make at property auctions, and I've asked him to talk about underwriting properties at auction as well, which is a really, really interesting opportunity for people. So we've got a real auction expert with us next month. I'd like to thank our three experts this evening. Sam did a fantastic job as always with our lending update. So thank you, Sam. Thanks for Julie, which was nice that you got quite a few wows with that, Julie, and I think there was a nice balance of benefit for tenants and landlords. So that was a really good story. And Danielle, obviously your expertise in capital allowances is impressive, and it's great to have somebody that we can talk to on that really important aspect. So I'd like to thank our three fantastic speakers. Thank you very much, and I'd like you all to stay safe, have a nice evening, and we'll see you next month. So thank you all very much.
Thanks, Chris.
Great evening. Thank you.
Thank you all. Thank you very much.